Let's get back to the markets and bring in Kevin Burkett, portfolio manager at Burkett Asset Management. Thanks so much for joining us today, Kevin.
Thanks for having me, Jacqueline.
So it is that sort of time of the year where we're looking back, but also even just the time of this week that we're looking back at the week that was. What do you make of the shift in the language from the Fed, the market reaction, and all of that?
Yeah, it was certainly a wild week in markets. Just about everything was moving higher, and mostly on what's been a continued weakening of the macroeconomic picture, and so spurring on expectations that some of the rate hikes that we experienced in 22 started this year reversed to cuts in the coming year. And so, the question we were left with, and I think some of that question was answered by today's move, was whether things were overdone. And certainly here we're very cautious as we kind of turn over to 2024.
You're feeling cautious, Kevin?
Yeah, I think, when you're in your recap of the day, you're talking about odds of the next monetary policy meeting, so the January meeting, and whether we see a cut or not. And you can look ahead on overnight index swaps and see what's pricing in. And after this week's move, we see expectations at around 5 cuts in 2024 here in Canada. And that seems like a wild expectation to us. I think to expect that policymakers reverse course and cut rates to that degree would, I think, infer maybe a policy failure or otherwise an overshoot of the 2022-23 era hike. So to us, that seems, nearly impossible. And I guess, where we think that becomes even more interesting is if it was that those sorts of cuts could be justified, what would equity markets look like? So how would you justify cutting rates that would get us to 3.75% at the end of next year? Certainly, that would require a very hard landing type downturn. So why equities moved higher this week? To me, there's a sort of myopic hyper-focus around changing directions on rates and whether we expect inflation to continue to recede, but not justifications for adding stocks at these levels, in our opinion.
Yeah, I think that's a great point when you're thinking about what those interest rate cuts would be responding to. Is it responding to inflation coming down and, cheering that on, or is it responding to the economy slowing, which would be needed for inflation to be cooling as well? So, it is interesting, an interesting picture you paint there. When you're thinking about then the TSX over the next year, I know it's difficult to say where things are going to be in a year because, my goodness, how much things can change over the course of that time. But what's your sort of, base case for equities?
Yeah, it's hard to have a base case in this environment. I think we look at potential ways forward, and we think about risked odds that markets follow those paths. What I mean when I say that is, we always welcome positive markets, but if this week was a reminder of the myopic, hyper-focused nature of markets when it comes to some of the macro data, I think we spend more time finding and investing in businesses that we consider all-weather without regard to sort of cauldron of forces that drive the global economy. I think when we think about the year ahead, I suspect that this week's run, in particular in U.S. equities, spurs some to be adding risk. I think we think the opposite. I think what we're seeing is classic melt-up, and I think that for us, taking advantage of the current rate environment to build a sort of safe bucket in fixed income makes a lot of sense. And I think buying equities that are in the category of needs as opposed to wants, sort of a classic, additions without regard to where we might be in the economic cycle. And we find that tends to work better than laying bets on what the monetary policy out of the U.S. Fed or the Bank of Canada are going to do at their next meeting.
Curious to get your thoughts on a couple of stories that we've been following. The Trans Mountain Pipeline, the warning that there could be a 2-year delay here. I wonder what you're thinking on that front, what kind of impact that could have on the industry as well.
Yeah, I chuckled a bit when I read that headline this morning. I think it's another reminder that building pipelines is hard. It's been an expensive lesson for the Canadian government-owned Trans Mountain Corp. It's an interesting story, and it's been over a little while. Kinder Morgan Canada spun off Kinder Morgan spun off Kinder Morgan Canada back in 2017. 2018, we saw them abandon sell the pipeline to the Canadian government. And then in 2019, Pembina bought Kinder Morgan Canada. And so there's an interesting linkage, I think, in yesterday's announcement where Pembina purchased some of Enbridge's interest in 3 joint ventures, and perhaps the risked odds that Pembina buys back Trans Mountain Corporation, which was a lot of people's expectation. But as far as that 2-year delay, I suspect that's more a move to try to apply pressure on the Canadian energy regulator as a way of hoping that they see some alteration in how they plan to build that pipeline change. But in my opinion, the path to ownership of that pipeline, privatizing it again, which is, I think, the intention, it just looks exceedingly complex. And I think actually Pembina's willingness to participate, which was previously an overhang on that stock, is maybe lifted somewhat by the deal they did with Enbridge yesterday.
Kevin, we've also been talking about gold a bit this week, is seeing some gains off of the Fed's decision on Wednesday. And I understand your thinking maybe around gold might be shifting a little bit as well.
Yeah, I think fundamental portfolio managers have been leery of gold for a long time, and for good reason, because on a fundamentals basis, it's been perpetually expensive. There's a category of investor out there that had historically really liked gold and been willing to buy shares in some of the largest gold producers at seemingly any price. And for us, when we look at those companies, and this is a really key question, if you're going to manage Canadian equities, you really have to have some deep thoughts around whether you want to participate in precious metals or not. But more and more, we think there's a defensible case for getting invested, even on a fundamentals basis. Some of the gold producers now are making sense in terms of the valuations we're seeing. I think one of the companies that we added over the kind of in the mid half of the year, and we've sort of just accumulated our position, is called Sandstorm Gold. We like the royalty streamers, the volumetric production payment oriented businesses for their lack of exposure to cost structures. So it used to be that gold, which is always a volatile commodity, but in good times, often you would see inflation of costs, and so your profits would leak away. I think royalties gets you around that problem, and where the only thing you could say against royalties, arguably, is that their owners tend to trade expensively, which is one of the reasons we like Sandstorm. Is we think that on a value basis, there's good value in that stock, and it has a lot of underlying royalties, arguably too many. But about 10-12% of that business's value is in one project in Turkey called Hod Maden, and there was a change in operator on that project, SSR Mining, who has a track record of successfully bringing mines into production in that country. And so Sandstorm is a name that we like, and we think gold is worth a look, particularly if we see the discussion on rates turning over.